Modern Real Estate Practice, page 280. In practice, the decision to borrow against the equity in a home should not be made lightly. Using the funds to make home improvements should at least result in a higher property value. Building up additional equity to replace some or all of that encumbered. To prospect of paying off other kinds of debts, particularly credit card and auto loans, may be enticing, but those debts probably won't result in the possible loss of one's home. Financing legislation. The federal government regulates the lending practices of mortgage lenders through the Truth in Lending Act, TILA, Equal Credit Opportunity Act, ECOA, Community Reinvestment Act of 1977, CRA, and Real Estate Settlement Procedures Act, RESPA. Recent legislation to assist property owners during the economic downturn is also discussed. Truth in Lending Act and Regulation Z. Regulation Z, enacted by the Federal Reserve Board to enforce the Truth in Lending Act, TILA, requires that credit institutions inform borrowers of the true cost of obtaining credit. With proper disclosures, borrowers can compare the costs of various lenders to avoid the uniformed use of credit, regardless of the amount. Regulation Z generally applies when a credit transaction is secured by a residence. The regulation does not apply to business or commercial loans or to agricultural loans of any amount. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, Dodd-Frank, transferred most of the Federal Reserve's responsibilities for enforcing TILA in July 2011 to the new Consumer Financial Protection Bureau, CFPB. Information on the reasons why CFPB was created, including mortgage loan abuses by lenders, can be found at www.consumerfinance.gov. Under the Truth in Lending Act, a consumer must be fully informed of all finance charges and the true cost of the financing before a transaction is completed. The finance charge disclosure must include any loan fees, finder's fees, service charges, and points, as well as interest. In the case of a mortgage loan made to finance the purchase of a dwelling, the lender must compute and disclose the annual percentage rate, APR. In 2009, the Helping Families Save Their Homes Act amended TILA by requiring that consumers be notified of the sale or transfer of their mortgage loans. The party acquiring the loan, whether a purchaser or assignee, must provide the required disclosures no later than 30 days after the date on which the loan was acquired. The Consumer Compliance Handbook for Regulation Z, which is updated regularly, can be found at www.federalreserve.gov/board/sup/manual/CCH/till.pdf. Creditor. A creditor for purposes of Regulation Z is any person who extends consumer credit more than 25 times each year or more than 5 times each year if the transactions involve dwellings as security. The credit must be subject to a finance charge or payable in more than 4 installments by written agreement. 3 business day right of rescission. In the case of most consumer credit transactions covered by Regulation Z, the borrower has 3 business days in which to rescind, which means cancel the transaction by notifying the lender. This right of, over here just shows the links to the Federal Reserve Consumer Finance, page 281. Rescission does not apply to owner-occupied residential purchase money or first mortgage or deed of trust loans. It does, however, apply to refinancing a home mortgage or to a home equity loan. Advertising. Regulation Z provides strict regulation of real estate advertisements in all media, including newspapers, flyers, signs, billboards, websites, radio or television ads, and direct mailings that refer to mortgage financing terms. General phrases like flexible terms available may be used, but if details are given, they must comply with the Act. The APR, which is calculated based on all charges rather than the interest rate alone, must be stated. Advertisements for buy-downs or reduced rate mortgages must show both the limited term to which the interest rate applies and the annual percentage rate if a variable rate mortgage is advertised. The advertisement must include the number and timing of payments, the amount of the largest and smallest payments, and a statement of the fact that the actual payments will vary between these two extremes. Specific credit terms such as down payment, monthly payment, dollar amount of the finance charge, or term of the loan is called triggering terms. These terms may not be advertised unless the advertisement includes the following information: cash price, required down payment, number, amounts, and due dates of all payments, annual percentage rate, total of all payments to be made over the term of the mortgage, unless the advertised credit refers to the first mortgage or deed of trust to finance the acquisition of a dwelling. Penalties. A creditor who fails to comply with any requirements of TILA other than certain advertising provisions may be held liable to the consumer for actual damage and the cost of any legal action, together with reasonable attorney fees. In other actions, a creditor may be liable to a consumer for twice the amount of the finance charge, for a minimum of $100 and a maximum of $1,000, plus court costs, attorney's fees, and any actual damages. Alternatively, a successful class action alleging that a creditor understand the APR and/or finance charge could make the creditor liable for punitive damages of the lesser of $500,000 or 1% of the creditor's net worth, plus attorney's fees and court costs. In addition, a willful violation is a misdemeanor punishable by a fine of up to $5,000, 1 year's imprisonment, or both. Equal Credit Opportunity Act. The Federal Equal Creditor Opportunity Act, ECOA, prohibits discrimination in the lending process based on the credit applicant's race, color, religion, national origin, sex, marital status, age, provided the applicant is of legal age, or receipt of public assistance. The ECOA requires that credit applications be considered only on the basis of income, the stability of the source of that income, net worth, total assets and liabilities, and credit rating. The protections offered by ECOA are both similar, race, color, religion, and national origin, and different from those of the Fair Housing Act. ECOA includes, here it shows the Equal Credit Opportunity Act. ECOA prohibits discrimination in granting credit based on race, color, religion, national origin, sex, marital status, age, and receipt of public assistance.